Taher Badshah in the last few months has been constructive, has been skeptical, and is he turning the curve, if you will? Taher, good morning. It's been a really long time, but thank you so much for taking the time out and speaking to us today.
In front of you.
No. So, Taher, what is the sense? I mean, the market is not showing any signs of bottoming out. Every single day there is a worry or other, and selling from your global counterparts, which tends to pressurize the market more. What is your sense, Taher? When do we see this pain coming to an end, if you will?
I mean, it's always difficult to call on time and timelines, but I think some of the things which are probably required for the market to kind of start looking a little more reasonable are being put into place. I think from the domestic side, I would like to argue that some of the requirements which the market has been looking for, especially from the point of view of restoration of growth, as well as in terms of somewhat milder regulation, again from the objective of trying to ensure that growth is makes a comeback, have been put into motion, um, both in terms of whether it be in the form of interest rates or whether it be in the form of regulatory moves by the RBI and so on, and trying to ensure that liquidity in the system is improved and so on. We all know about that. I think some of these things will probably take a little bit of time to percolate down into the system. My sense has been that we are going to see this first half of calendar year 25 continue with some of these things. I think the bigger problem is the global overlay at this stage. I would like to think that some of the domestic counter-cyclical measures have probably already been taken in order to, restore back growth. Whether it proves to be cyclical or structural, we'll have to see. But at least we can, there are some of these measures which are probably, are likely to start paying off as we roll forward. But I think the narrative globally is obviously against us, is against most emerging markets at this stage, including ourselves, and especially when we have been at the other end of the spectrum as far as valuations are concerned. I think that is resulting in what we are seeing in front of us on a daily basis today. So my sense, Neeraj, would probably be that we continue like this for the next 2-3 months for sure. I think once the global narrative settles down, when the administration, a new administration in the US is content with some of the objectives that they want to probably meet up with regard to trade, with regard to immigration, with regard to everything else that probably gives the US an upper hand. I think that will continue up until that time. We will probably see this scenario in the market. It will, and once that settles, I think it will lead to that reversal, which we are expecting, both in terms of maybe the valuation disparity between emerging markets and global markets starting to look a little more favorable for us, and flows also probably then starting to resume.
Got it. Taher, I have a question. So today, Chris Wood in his note, his belief is that this is a multiple compression, no macro worries. Now, enough people have said that this happened primarily also because Q2 and Q3, the numbers didn't look all that great, and people were worrying that what happens to growth per se. Now, my question to you is this: if there is a comeback, and naturally a comeback will be there relative to the numbers we've seen in Q2 and arguably Q3. If there is a comeback, if today's GDP print is slightly better than 6.2 as well, who knows, and all of that, does it shore up confidence at all? Or do you believe that because the global factors are a bit anemic right now and the news flow is very heavy, that even if growth shores up in India, we'll still have jitters to contend with?
So one factor alone will probably not help, and we'll have to see multiple things go in favor of the market for it to regain that composure and confidence. And I think that is exactly what I was trying to point out, that some of these measures have been put into place. Like, for example, we talked about interest rates, liquidity. We talked even about the budget, which at whatever level in its own way was trying to kind of bring that balance into the economy. And I think all these factors, and alongside which, if, like as you said, if you see a good print of the GDP numbers today, all these incrementally will help. No one factor will probably be enough at this stage of the market, because unfortunately the global narrative and overlay is very is considerably against us. So I think it'll take multiple factors to probably, I mean, it's apparent that there is a valuation compression, but we also know that valuation compressions do not happen unless the narrative turns against you, and that is what we are going through. That there is a compression of valuations, but then there is also we have been contending with a cyclicality of the P&L. I think the cyclicality of the P&L is being addressed, but valuation compression will continue till the time the narrative changes.
Taher, good morning. This is Tamanna here.
I do.
Some of the conversations we're having, and I know it seems maybe foolhardy to look for optimism in a picture that's looking so bleak even as we speak, but some of the conversations that we're having also indicate people who think that the worst is perhaps over. We are at the cycle may have bottomed out, and we may be now in oversold territory. Are you seeing any signs of that at all?
Like I said, I mean, some of these, the market is in a stage where some of these positives are also getting completely ignored. So there's a complete reversal from what you probably saw about a year back. Same time last year, we were in a stage of complete euphoria. And maybe that was also overextended to some extent. We can arguably say so. But I don't think our growth outlook has become so impaired in the last some time, especially in the last 6 weeks or 8 weeks to merit this kind of fallout of the market that we have seen, where two-thirds of the market has probably fallen 30%, 35% from its peak. So obviously we are swinging to the other end of the pendulum steadily and gradually. We are getting there. Today's day is also another day to the addition of that swing factor. So I think we are by and large getting very close. I would like to think for a recovery. We will probably have some time before a market takes cognizance of some of these measures. It will also probably look for a little more affirmation with regard to numbers, perhaps in the form of high frequency data starting to look a little better, public expenditure, consumption in whatever form. All of it, maybe as we go along, prospects of the monsoon probably will also matter as we get into the next couple of months. So I think all that incrementally will have to build up for the markets to kind of gain composure.
So that's a combination of factors we're seeing right now, isn't it, Taher? You have obviously our own fears of economy growth, etc., coupled with what's happening on the tariffs front. I just want to get your sense that on the tariffs front and from that perspective, is the fear from the Indian POV a little overdone? Because right now what has happened in the last 24 hours is essentially a threat that was made now seems like it will be followed through. In terms of the first set of tariffs announced, Mexico, Canada, etc., is it overdone that the same could be what India sees?
I think we have gone in the last 8 weeks from a stance of probably India will remain completely unaffected to now by and large getting into the camp where India will not be spared at all. So that is how the swing once again is happening here as well in terms of the narrative. I think not just for India, perhaps the reality in my view for much of those countries where reciprocal tariffs is a larger issue will probably end up somewhere in between, not exactly on those extremes on either side. So I think we will have to, as an industry, as a country, be prepared for some of the industries coming under a little bit of that impact. And I think probably I heard of some measures which are, I mean, some speculation around government contemplating a few more measures in order to, reduce tariffs for US imports, which obviously then give them a little more flexibility to work out a bargain on the other side. So I think that to and fro will probably happen just like it is happening for other countries. It will happen for India as well. And I go back to this thing that till the time this gets settled, and I think we are coming close to that. I think April 1st is what the administration out there wants to probably roll out the new tariff. So I guess in the next couple of months we will see the settling of it, at least for the timing, if not forever. And then that is. But these are some of these things where we don't know the second order implications. We also need to see how the US holds up as an economy after all this. And I think, to my mind, I think we're getting to a stage where the earnings upgrade cycle probably in the US might come to an end, and the earnings bottoming cycle in India might probably come to an end with the next some months. And that again is a feature of is a reason why we should incrementally probably start getting positive on the markets from here on.
Taher, one final question has to be on IT because that index is sunk today. Now, 3% down. My question really is that, is this a fear of the US economy also starting to show chinks at the armor? Or is it a fear that AI could really significantly disrupt? Because almost every second person says that one thing that AI will do is take away all the low-cost jobs across the world, of course, and therefore maybe even in the Indian back end too. I would love to understand how you think about IT. And is this a time to buy or would you avoid it?
So we've kind of had phases where we have probably been optimistic about the sector and last year sometime middle of last year and then early part of this year as well. But those we are having those swings at our end as well, and precisely for the same reasons which you mentioned. One is obviously not able to get a hold of what the market will probably want to discount first. I think there is a fair bit of possibility that you may have some improvement, cyclical improvement in growth for the IT sector first before it starts to kind of wilt as I expect that probably you might see US economy starting to peak off as we get into the next 6-12 months, and some of these other issues start to affect their economy as well. So that is one factor which, so in the near term, I would like to think that it is positive, but and also backed by the fact that now we are getting things at a relatively better valuation. But I think I have been trying to understand the whole AI part a little more better in the last some time, and to my mind, I think the reality is probably going to be a lot more challenging than what we have been assuming. I think on all of us, not just on the IT sector, but in general, I think as we move from AI to Gen AI or AGI, I think it's going to be a lot more difficult across many other industries as well, not just tech, for that matter. So it is going to be a landscape which will be relatively difficult to trade on as we go along, and therefore it will. Because we would not have immediate answers in terms of cyclicality of P&L, what the market will definitely do is to cap multiples or probably even settle multiples down at a notch lower than what they've been traditionally used to. So I think we still probably might see that grind where earnings do start to get a little better over the last couple of years compared to the last couple of years, but multiples compress, and therefore probably at best we end up flattish if we are lucky as far as the tech sector is concerned.
Got it. Well, I think we can do with a lot more luck, considering how the markets are behaving in the recent past, Taher Badshah. Yeah, but thank you so much. Really appreciate your time this morning.
Lovely, thanks to me also. Thank you.
Yeah.